Hi, this is Jim Cunningham, and welcome to Start 2022 Tax Planning Now. This is like kick strategies into high gear. Do not wait, especially if you're a California resident, because we'll see why it's really important if you're a California resident. This is information only. It's not legal advice. It's not tax advice. It's not financial advice. Don't look at this and go off and do a bunch of stuff and said, well, I saw Jim talk about this and then, do a bunch of stuff. Not a particularly good idea. Go ahead and subscribe to our YouTube channel. This is live. If you're watching this on our webinar, I would really encourage you to go to our YouTube channel, check it out, subscribe, and also you can hit the share button. So if you think this is something you might want to share with a friend or a loved one, you can go ahead and share that and say, hey, check this video out. So I'm Jim Cunningham. I'm the managing partner of Cunningham Legal. We have offices in Northern and Southern California. And you can see here pretty much the Bay Area, Capital Region, and Southern California. So here's the deal with tax planning. Tax planning is not something you do April 17th. April 18th is the tax filing deadline for 2022. For tax year 2021, this is not something you want to start when the year is over. Okay, you want to start thinking about this now, because many of these strategies, as you'll see, they are time sensitive. So some of them you will want to consider implementing earlier in the year rather than later. 2021 was very stressful for a lot of our clients, very stressful in my industry. We thought the Build Back Better was going to pass. It looks like it hasn't passed yet. It might come back in some other iteration. But 2022, we're in an election year, of course, where we have our congressional elections and many state elections. Also a very important ballot initiative in California I'm going to talk to you about. Also RMDs. This is a real quirky year for RMDs because the rules changed. So as you'll see as we go through the materials, they're changing for everyone, okay? Not just the people who are turning 70 and a half or not last year. And we'll talk about that. And we'll talk about future changes, anticipated changes, things that are happening on the horizon, and the sunsetting of certain tax breaks. Should you consider a mega Roth conversion? If you have an IRA, a 401k, many of our clients do Roth conversions, and I'll show you why that might make sense, but it's something you want to think about now. Don't do it at the end of the year, because when you do a Roth conversion, timing is really critical, because there are some tax strategies that you can use. And to fully utilize those tax strategies, if you are considering a Roth IRA, if you're a California resident, earlier in the year is better than later in the year. We're going to talk about tax arbitrage, and also the thing I've been talking about with California. When you do some tax planning, you can do it December 31st of a given year, and that's good for the whole year for the federal government, for federal tax planning. But for California, it's only the last quarter. So California doesn't divide time into years, they divide time into quarters. And why that's important is if you do a tax advantaged investment in the first quarter, you're going to get credit for the full year. If you do it in the fourth quarter, you will only get credit for that portion of the year, that quarter. So it's just kind of best practices to be top of mind. Many of our clients pay almost as much in state income tax as they do federal tax. Okay, so California has very high federal tax. California has different rules in the federal government as well. RMDs apply to most IRA accounts, period, across the board. And what I mean by that is while you're alive or after you pass away, there is something called a required minimum distribution. The reason we have required minimum distributions, we used to not have them before the 1980s. And then Congress saw all these IRAs and 401ks get really big. And they said, wait a minute, money has to come out of these at some point. And so then that's when they created this required minimum distribution. Roth IRAs, it's important to note, have no minimum distributions until the account owner's death. And you might say, well, Jim, that's not a big deal because, I wouldn't pay tax on that money anyway. Bear in mind, while that money's in the Roth account, it is getting interest or income and principal growth, right? Capital appreciation, free of tax ever, free of income tax ever. So it's better to leave those accounts in the Roth. And for some of our clients who have large IRAs, the required minimum distributions can be several $100,000s a year. So these are not small numbers we're talking about. 401ks have no RMDs if you're still working, even if you're 70 and a half or 72. Now, this is really important. The Secure Act took effect in 2020, and RMDs were generally required for people who were 70 and a half. That has been raised to 72, but there's a little wrinkle on that this year. So if you're born before July 1, 1949, if you're born July 1, 1949 or later, your required beginning date is when you turn 72, not 70 and a half. But if you're born before July 1, 1949, then, it's 70 and a half. So there's that interesting little wrinkle in there. So the amount, so how much do you take out for an RMD? Well, the amount each year is determined by dividing the previous year in balance. So we're in 2022. If you have to take an RMD out for 2022, you look at what was the balance on your account on December 31 of 2021, and you divide by a certain number. That gets you a fixed dollar amount that must come out by the end of the year in most situations. But this is really important. There are new tables for 2022. And so the IRS now assumes that you're going to live longer, and it's about 2 years longer. Well, the net effect is it reduces the amount of your minimum distribution. So living longer is better for a lot of reasons, but one of the reasons that living longer is better is it reduces the minimum amount you must take out of your retirement account. Now, this is the new uniform lifetime table. I want you to look at something that I've circled in red. Draft as of January 5, 2022. We're in February. Folks, the IRS hasn't finished this. This is draft. This probably is going to be what the number is, but this is really important to pay attention to. And this is just in general with taxes. This stuff changes all the time. People get caught unaware and they end up paying more taxes than they otherwise would. So this is why it's really good to have an A team. It's what you've heard me talk about that before. Your A team, your estate planning attorney, your financial advisor, your CPA, all working together. And I'll tell you, too often those people don't work closely enough. So if you turn 70 and a half in the second half of 2021, now just think about that. No one has a half birthday. I guess some people do. If you turn 70 and a half in the second half of 2021, your required beginning date is age 72, the year you turn age 72. But if you turn 70 and a half in the first half of 2021, then you're subject to the RMD age of 70 and a half. So and I'm sure there are people, we got a lot of people on this webinar. If you're on this webinar or you're watching this on YouTube and that's you, please pay close attention. If that's not you and you have someone that you care about, please share this information with them, okay? So here's where it gets a little dicey. If in the first year that you receive an RMD, the amount that you have to take out that you normally have to take out by December 31st can be delayed until the following April 1st. Well, what that means, of course, is you have one April 1st and you've got one December 31st. Now, many people do wait to take their minimum distribution for a variety of reasons. And so they end up with two minimum distributions in 1 year. Well, what makes this year weird, okay, I'll just use the W word, is for your 2021 required minimum distribution, you use the old life expectancy. And for, right, so if you did not take a minimum distribution in 2020, if you've turned 70 and a half last year, you can take a minimum distribution April 1st of this year and December 31 of this year, but your April 1 minimum distribution is going to be based on the old life expectancy tables, and your minimum distribution for last year is going to be based on the new minimum distribution rules. So what I mean by this is you will have a minimum distribution. If you turned 70 and a half last year, you'll have a minimum distribution this year and this year, April 1st, and this year, December 31st, but you're going to use two different life expectancy tables. I will tell you that when I saw this, I immediately thought people are going to mess this up. And this is something you need to pay attention to if this is you, because you do not want to take out more than you need to, okay? You certainly want to take out as much as you have to, because if you don't, there's a penalty. There's a 50% excise tax. Certainly if you have a self-directed IRA, where you have minimum distributions, you really need to pay attention to this, okay? So let's look at what the new RMD rules are. These are minimum distribution rules. This is new for this year. This is a new tax law, right? A 72-year-old has an RMD of 1 divided by 27.4 times the account value, or the account value divided by 27.4, which is 3.6%. And if that person is 10 years older, it's higher. You can see they're 5.4%. And if it's a 92-year-old, it's 9.25%. Now, these RMDs might be short-lived because the IRS has said that they're going to be updating these far more frequently going forward than they have in the past. The pandemic has actually caused life expectancies to drop. So it is possible that we could end up in a year or two or three or four, whenever that happens, that these future tables may reflect a shortened life expectancy, which means a higher RMD or higher required minimum distribution. So if you got all that, you probably qualify for a master's in tax, and I will take some questions here. So how does this affect someone that is already taking the RMD? Anita, it does, because it changes the amount of your RMD for this year. So if you're already taking your RMD, it's going to be a little bit less. Now, for many clients, if you're with a financial advisor, that tends to be an automated thing, but not all of our clients have their retirement accounts with financial advisors. Okay, sometimes they're self-directed. Yeah, okay, Carol, thank you for pointing that out. The importance of taking charitable contributions from your RMD, especially of taking the standard deduction. Carol, thank you for mentioning that. We did mention that in a prior webinar, and that's very important. If you take the standard deduction and you are not itemizing your deductions and you have a minimum distribution, you can make a gift directly from your IRA to the charitable institution, and that money never lands in your taxable income. So frankly, you just end up with more money and the charity ends up with more money. But thank you for pointing that out, Carol. And we have one more question here. Does the exclusion of having to take an RMD if you're working in your 70s for 401s also apply to 403Bs? Yes, generally speaking, if you're still working past age 70 and a half or 72, you don't have minimum distributions from those employer-sponsored accounts where you're working. So that's very important. So let's look at, let's look at an example here. So if Hal has $1 million IRA and he's 72, his minimum distribution is 36,000. If Hal's 82, it's 54,000. If Hal is 92, it's 92,000. But the point that I'm saying is, as you get older, the amount that you must take from your retirement account increases, okay? The percentage increases, that piece of pie increases. And in a normal IRA, Hal has to pay income tax on that money that comes out, even though he doesn't need it. Now, the point of this is, even at 92, right? On $1 million IRA, if 92,000 is coming out, that IRA may have a return of 10% in a given year. I mean, look what happened last year. Who knows what's going to happen this year? But these IRAs, a lot of people, I think, have the false belief that these IRAs will not be around when the IRA participant owner passes away. That's simply not true. So planning for this wealth transfer is important to many of our clients. And so many of our clients do choose to do advanced planning when it comes to IRA accounts. So other changes in the tax law, Build Back Better did not pass, but elements are kind of floating around. Who knows if it's going to pass? Who knows? We have, again, midterms coming up, and we can all sort of speculate on what the result of that's going to be. And I tell you, we have a lot of people on here. Half will probably go one way, half will go the other way. But here's what's at risk. Here's what we're sort of seeing as trends in the law. I think Roth conversions are at risk. Right now, it doesn't matter how much money you have. It doesn't matter how much wealth you have. You can convert your IRA to a Roth. Yeah, you have to pay the tax, but there's no limitation. There was a proposed limitation on the amount of income you could otherwise have and still do a Roth conversion. So it was a throttling back of this Roth conversion. The death tax hike is not a question of if, but when. We were kind of early on in 2021, we were looking at the potential of the Biden administration cutting the death tax exemption, which has the effect of increasing death taxes. That didn't make it through. But remember, the Trump era extra 5 million we get, and we'll talk about that in a little bit. The Trump era extra 5 million we get goes away in 2017, or goes away in 2026, right? It was passed in 2017. It goes away in 2026. It will affect frankly, many of our clients, right? 1031s, I think, are at risk. And the limitation on the 1031 is basically if you're a high income earning person, you can't do a 1031, or you can do less of a 1031. I think those are still at risk. The big players, the really big investors, institutions, they really don't do 1031s. Okay. So, I don't know where we're going to go on this. The higher income tax rates are likely in the future. You know, we're seeing interest rates go up. I don't see how the government can continue functioning without raising income tax. I'm not advocating raising income tax. I'm just speaking reality is that we're at a low point when you look historically on what the government is collecting from incomes. We're at a historical low point. Everyone I talk to anticipates that there is a probability that those will go up. And you're seeing a fair amount of political traction on increasing income taxes. Again, I'm not advocating that. I'm just telling you what I think may happen. That ties into the Roth conversion, because it may be better to do a Roth conversion while tax rates are comparatively low if you believe that they will be higher in the future. By the way, the federal government had the highest amount it ever collected in tax revenue at the end of September of last year. It was $4.1 trillion. The national debt, I believe, is right around 30 trillion. But that's a lot of money for a government to collect $4.1 trillion in tax revenue. Grantor Trust planning strategies may evaporate. Those may go away. And we'll talk a little bit more about what those are. Again, if you're, these limits kind of go up every year. The gift tax limit is up to $16,000. We'll cover that in a little bit. If you're under 50, you can contribute now $20,500 to a 401k. And if you're over 50, $27,000. This research and experimental expenditure deduction is now 5 years. It used to be 1. So for those of you who are in business and maybe write software that you're not selling, but internally, that's kind of one of the biggest line items we see on that. That's going to be over a 5-year period, no longer a 1-year period. And then carried interest now has a 3-year hold to get capital gains tax treatment. So I do want to talk about property taxes and Prop 13. Our clients who have Prop 13, they love it. If you own property in California, I saw today that the inflation rate January to January is 7.5%. The state of California can only raise your taxes 2%. So, if you owned property a year ago compared to now, you benefit from Prop 13. So there is the Howard Jarvis Taxpayers Association has an initiative to repeal the death tax. I believe the deadline is March. It needs 1 million signatures to get on the ballot. This would bring back the parent-to-child reassessment exclusion and expand it to 2.4 million. We've talked about this in prior webinars. If this is something that is of interest to you, I would go to hjta.org, and check it out. You can actually order the petitions if this is of interest to you and have your neighbors sign them, or, do a petition drive or set up, a folding table in front of a supermarket, depending on how important it is to you, right? But this does need 1 million signatures, and that's not a small number, okay? So if that's of interest to you, I would suggest you reach out to that organization. So higher death tax, I mentioned on the horizon in 2026. I'm going to take just a couple of questions here. Let's see. Anonymous says, is part-time considered working in your 70s to avoid RMD for 401k? Anonymous, I think you'd have to talk to your HR or financial advisor. I think that's case specific. Carol says, if you give away $5 million now, might you be liable for gift tax later if the estate exemption goes lower? Carol, it depends on the totality of the circumstances, but I will tell you, Treasury has come out and said there is no clawback. I'm not quite sure what that means, but there is no clawback. Let's see here. I was under the impression that you do not need to take RMDs until you turn 72 and a half years of age. No, it's 72. Depends on when you're born. If you're born before July 1, 1949, it's 70 and a half. If you're born after July 1, 1949 or later, it's 72. Ani says, I made a mistake and my contribution came on my credit card. Do I have to reverse the payment, or will a letter from the nonprofit saying it is from my IRA be sufficient? Ani, if it was last year, I think you may be out of luck on that one. I would check with your tax advisor, but typically these are trustee to trustee transfers, meaning it goes from the custodian of your IRA directly to the institution. Anita asked, do you know if the Howard Jarvis Taxpayers Association is eliminating the 3 property tax moves for over 55? That is not my understanding. It is just, Anita, it is just bringing back the parent-to-child reassessment exclusion. Higher death tax is on the horizon in 2026. The estate exemption is now $12,060,000. So what an exemption is, think of it as a coupon. It's an ability to leave $12 million or gift $12,060,000 free of any transfer tax. Forgetting, Don't forget capital gains tax, forget income tax. All we're talking about here is there a gift tax or an estate tax? Now, if you're married, that doubles up to $24,120,000. So meaning a married couple, if a married couple passes away in 2022, $24,120,000 can go free of any death tax. Now, there are state death taxes, okay? So now I use the term death tax. Some lawyers will say the technically correct term of estate tax, but death tax happens when you die. Estate tax, people don't understand what that is. So that's why I say death tax. Gifts of $16,000 or less do not require a gift tax return. So you can give $16,000 to each of your 10 grandchildren, no gift tax return, right? They'd be very happy grandkids. These laws sunset December 31, 2025. What does that mean? Sunsetting means the party's over. The day of this expanded $5 million exemption plus an inflation adjustment, that's how we get to 12 million. That day ends because the law sunsets. Like the sun sets at the end of a day. That's what we lawyers refer to as a law ending without any further legislative action. As the sun sets at a given time, so the law sunsets. That exemption is going to be cut in half. It's going to be $6,030,000 per person, adjusted for inflation, okay, or $12 million per couple. But these are two $5 million exemptions with inflation adjusters. Now, there is a 3-year look back for gifts. The IRS has said there's no clawback. I'm concerned as I read these, that makes me nervous. So if you have an estate of greater than, if you're going to make a gift of greater than $6 million, you may want to think about doing that in 2022 and not waiting till 2025. Because if you do the math on the 3 years, I'm just concerned Treasury is going to change or modify their position on this. Congress is empowering, by the way, something you need to know that's happening in the crypto space. There's a bill in Congress to give the Treasury Department very broad power to regulate cryptocurrency. So to impose a whole lot of regulations without public comment, which is a little scary. So I think that the shift is to give Treasury more power to change rules, frankly, going forward. So let's look at Hal and Wanda. They have a $30 million estate. Hal sets up what's called a spousal lifetime access trust for the benefit of Wanda. Hal puts $12 million in assets in it. Hal has used up his exemption. That money is used for Wanda's benefit. Hal cannot benefit from that property. Hal cannot be a trustee. This property can never come back to him. It is a gift to his wife. Wanda creates a family limited liability company in Wyoming. We choose Wyoming because it's a great jurisdiction to have a close LLC, is what is called a close, C-L-O-S-E LLC. And she puts in $12,181,818.20. Then she turns around and she gives away 99% of the shares of this Wyoming LLC into a dynasty trust for the benefit of her son, Sam. So what we've got here is Hal sets up a trust for his wife. Wanda sets up a limited partnership and keeps 1%. She's the manager. And then, so she still has control. And then she transfers 99% to the son. And Hal and Wanda have fully utilized their death tax exemption, shifting the future growth of these assets to Sam outside of their taxable estates. And this will save Sam more than $5 million in death tax. So this is kind of an example of what some people are doing. Hal and Wanda also super fund a 529 for the grandson, Greg. You see grandson, Greg with a G. You see where I'm going. Hal, husband, Wanda, wife. Okay. Hal and Wanda super fund a 529. They put 80,000 each. 16,000 times 5 is 80. And then for a combined 160,000, free of gift tax. This is really important. This is free of gift tax. This is super funding a 529. If you're wealthy and you're concerned about your grandkids' education, this is a really great thing to do. In fact, we had the gift of education as a webinar recently and as a blog post on our website, which I would encourage you to look at. So they don't wait till the end of 2022. Why not? Why wouldn't they wait till the end of 2022 or 2025? This planning, I will tell you, this is not something that every lawyer can do. This is not something that every estate planning lawyer can do. This is a subset of lawyers. And there are very few lawyers who really understand this planning. And I will tell you, they happen to be in states like California, Florida, DC, New York, Chicago. And they are in the other states, but there's a higher population where frankly, where the rich people are living in the higher tax jurisdictions. Now, Hal and Wanda correctly assumed that there will be a traffic jam of people wanting to make gifts like these the closer we get to the end of 2022 and 2025, which is absolutely what I think is going to happen. It's going to be a traffic jam. There's going to be no room at the inn. Okay. So we got Mary here. She says, I'm going to give birth to baby Jesus. Knocking on the door, there's no room at the inn. Okay. So something you need to think about is if you have assets of more than 5 or 6 million, and you want to do some sophisticated planning, you want to maximize the creation of intergenerational wealth, you may find that there is no room at the inn when it comes time to find a lawyer. It happened during Prop 19. It happened last year. A lot of people were scrambling, and a lot of people that reached out to us said, I've been calling law firms and they were booked up by the summer. Okay. So this is something, if you're thinking about doing this, I would not wait on this, but I would get on it. Now, death taxes are a layered cake. I have a cake here, which is 2 layers, that thick layer of frosting in the cake. And I'm going to mention presidents, but I'm not making a political statement. I am identifying so that, I'm giving it a name so that we can put it in our brain and collectively understand this, because these are not easy concepts to understand. And I believe in making things as simple as possible. In 2011, we got a $5 million Obama cake. You can look at that cake right there and you see that yellow cake. That was what we got during the Obama administration. We got a $5 million death tax exemption plus an inflation adjuster. In 2017, during the Trump administration, we got another 5 million on top of that. Frosting is on top of the cake. Now, something you need to understand, and this is a little bit of you're going to have to think about this one, because when I first saw this, I thought to myself, well, that's really interesting. I'm not sure I totally understand that. Gifts are made from the cake first. They are made from your oldest exemption first. There are 2 exemptions here. There's the Obama exemption in 2011 and the Trump one in 2017. The Treasury Department has come out and said, if you make a gift of $1 million, you're making it off the bottom of that cake. You are not making it off the frosting. So if you think to yourself, well, I'm going to give, $5 million before 2026, and I'm just going to be able to give my Trump death tax exemption. When you make that gift of 5 million, with inflation to be 6, you're not making it off the frosting. You're making it off that cake first. So in 2026, as I said, that frosting is gone. So where I'm going with this is, unless you're making a gift of more than $5 million adjusted for inflation, be 6, unless you're making a gift of more than that, you're not even going to eat into the frosting. And so all you've done, if you make a gift of $6 million and you say, all right, I took advantage of that Trump era $6 million and then pass away, you've totally used up your estate tax exemption. You have nothing left, right? So it's just important to understand the interplay of these 2 exemptions and how they work. Now, for those of you who say, well, I have $5 million, or we're a couple with 12 million. What do we do? Because our assets increase faster than the exemption, right? So this $5 million exemption goes up with inflation, but many of our clients, their assets increase faster than inflation. So what can you do? Now, there are still several planning techniques. Some are on the chopping block, but they would likely be grandfathered in. Okay, so everything I've read is, as long as that trust is irrevocable, it's grandfathered in. So these are the 2 biggies in my space. These are what we call estate freezing techniques. What do we mean by that? It means the value of the estate is effectively frozen. So the value of your assets, instead of increasing, that future growth goes to the next generation, right? So what you're able to do is you're able to kind of keep your estate static as the death tax exemption increases over time. You see how these 2 pieces fit together? So you've got a $6 million estate that in 5 years is going to be worth 9 million. Well, there are ways that you can have that $3 million growth, or most of it, go to the next generation without paying any transfer tax. So I would almost say that the people who have a $30 million estate, they can use this planning as well. But I think the people with the smaller estate really need some fairly sophisticated techniques in order to avoid that death tax, right? So an IDGT, this is called an IDGT, an intentionally defective grantor trust. Now you would say, why on earth would I want anything that is intentionally defective? This is a terrible name. I didn't give it this name. I would have called it something else. Terrible name. basically you sell property to an irrevocable trust. Now there's a revocable trust, which is a living trust. There's an irrevocable trust, which can't be changed, can't be amended. You sell that rental property or that stock portfolio to this IDGT, and you take back a note. Now, when you sell this, this is not considered a gift, is also not considered a taxable event, because what defective means is even though you've given the property away, you as the donor are still deemed the taxpayer. So if you sell something to yourself, there's no capital gains tax, all right? So, and again, this big caveat, I'm giving you a very high level. There's detail that's right under the surface I'm not telling you, but I would say certain restrictions apply on these. So here's an example. Hal creates an IDGT. Hal transfers $100,000 in cash to the IDGT and $900,000 in Apple stock. When you're selling something to an IDGT, you have to have some cash in there. You just can't sell the stock, right? Now, the sale, Hal exchanges his $900,000 in Apple stock for a note that bears 1.6% interest. Okay. So what this means is any increase in that Apple stock beyond 1.6% goes to Sam free of any death tax. Okay. So 10 years later, Hal dies. The value of the note is $1,160,000. And the Apple stock is now worth $3 million. So the difference goes to Sam tax free. He's going to get that $2 million or thereabouts, 1.8 million tax free to Sam. There's another technique called a GRAT, which is a grantor retained annuity trust. This is a very well-worn strategy, well-known strategy. It's used in estate planning to minimize transfer taxes on gifts. Many people will create GRATs of a 2-year period, 2-year duration. So you put money into this trust, you take back payments over a 2-year period, and when the trust expires, your loved ones get what's left over. So here's an example. Wanda, remember Hal's wife Wanda, creates a GRAT in 2022 with the 2-year term. She puts $1 million in assets. She gets back $512,000 in 2023 and $512,000 in 2024. During that time, the Apple stock, right? She contributed $1 million worth of Apple stock, increases 25%. So Sam gets $410,000 free of gift tax. This is a GRAT. Many wealthy families use these, and you can see why this is important. Because if you have an estate of $6 million and you're concerned that it's going to go up faster than the exemption will go up, you really can't make a gift because you won't have anything to live on, right? I mean, it's a real problem. And if you make a gift, you will have no death tax exemption left, okay? So what we're talking about here is freezing the value of your estate, or maybe you have an $8 million estate and you need that exemption to catch up to where you are. So these are very powerful tools. These are kind of on a prescription basis only. This is not a DIY project. You absolutely need to go to a qualified lawyer. There's a solar street lamp project. If you've seen our solar stuff before, the numbers tended to be bigger. There is a new movement with residential development to install street lamps that are solar powered with a battery backup. Now, what this does is this reduces the overall cost of putting street lighting into a new development. This is from a development in Florida. And in this case, the investment amount is actually less than $100,000. It's $56,000, but I wanted to use $100,000 so the numbers are a little bit clearer to understand the concept. Hal and Wanda invest $100,000 and they buy several street lamps, right, in Florida. They pay, when they do this investment, they pay $45,000 less in taxes, okay? They get a tax credit and rebate of $32,000. So they put in $100,000 to buy these street lamps, but they pay $77,000 less in taxes. So the true cost, the net out of pocket, is $23,000. They get 5% a year for 20 years on that because they actually are going to get income from the solar production of these street lamps. And they're going to get $5,000 a year on a $23,000 investment. And if you do the math, that's 16.7% rate of return. I don't know where you're going to get that. I mean, that's nuts. The sun comes up, the sun goes down, right? So that is the solar street lamp project. If that's something that's of interest to you, you can certainly reach out through our website and we'll show you how to do that. But this is a powerful one. Actually, several of my friends did this. You know, this is a nice one because it's in bite-sized chunks. So if you're a high W-2 earner and you go, you know, I'm making $1 million a year and I'm really tired of, you know, paying all this tax money going out the door. You do $100,000 project. Look, you're going to pay $77,000 less in tax, and you're going to get income. I mean, it's not a bad deal. It's a pretty cool deal. So I'm going to take some calls. I'm going to take some questions, and then we'll talk about the mega Roth conversion here. So, Arthur asks, great question. Are IRAs included in the estate tax exemption of 12 million? Yes, they are. Aaron says, so if my mom passed away in 2021 and my father and mother have a Q-tip trust, should we make sure my father's moves my mother's portion into a B trust to ensure she gets to pass on her 12 million? Even though in 2025, the amount goes down to 6 million, that can be passed without death tax. Does that make sense? Yes, Aaron, I think you need to talk. If you have a lawyer that's representing your parents, talk to that lawyer. You know, if they're already represented, it's actually unethical for us to solicit a represented party. If that's something you want to talk to me about, or if your parents, you know, don't have representation, they can certainly reach out to us. That's something you need to meet with a lawyer on, and you need to meet with your A team on, because that requires, if you have an A-B trust structure, sometimes that's good, sometimes it's bad. If you have a higher net worth, sometimes it can be really good, but you have to be mindful of what goes into the B trust and how you manage those assets in the B and the A trust. What I mean by that is if you have an A and a B trust, that growth and a taxable estate, right? If it's a larger estate, you may want that growth to be in the B trust. Okay. So if you're going to have an investment portfolio, rather than having the same portfolio in both trusts, you might put your cash and your bonds on the A trust, but things are going to have capital appreciation. You might want to consider those in the B trust. Is the solar street lamp project available in California? Asha, I don't know yet, but you still, if you're a California taxpayer, you still get credit. So, let's see, answered that. Look back of 3 years. Yeah, before 1981, we had what was called a decoupled gift and estate tax structure. It became unified with the Tax Act of 1981. So the question is, what is this 3-year look back? It used to be that a gift made in contemplation of death, like subjectively, like how are we going to figure that one out? A gift made in contemplation of death came back into the estate. And then the government just says, look, anything you give within 3 years of death comes back into the estate. And that's what that means. So now clawback, Sandra, is if you make a gift of $12 million when the estate exemption is $12 million. And so you make that gift to your kids and then you die. And then when you die, the gift tax exemption is $6 million. Is the government going to come back and say, oh, you owe us 2.4 million death tax on that extra 6 million you gave while you're alive? The answer is no. Nancy asks, what's the difference between look back and no clawback? So I think I just discussed that. If I contribute to my IRA after age 72 years old, interesting. If I contribute to my IRA after age 72, either because I'm earning income or my husband is earning, and then convert the IRA contribution on the next day to a Roth, do I still owe the RMD? Does the RMD apply even if there is money in the IRA for only 1 day? There is a requirement that you don't take money out of the Roth for 5 years, anonymous. So that's something you'll want to talk about with your financial advisor on a case-by-case basis. Can you explain the difference between the AB trust and portability? Yeah, so it used to be back in the day when we could leave $600,000 free of death tax. A smart attorney came up with an idea and said, well, why don't we put, when one spouse dies, why don't we have the buried spouse or the below ground spouse fund this B trust post-mortem after death? And so what this B trust did is it allowed $600,000 of this deceased spouse's property to go into the B trust. And the reason is, if you didn't do that and the surviving spouse inherited everything, the surviving spouse lost that $600,000 exemption that the deceased spouse had. So husband and wife, husband dies, husband's half of the property goes to a B trust. That's better because otherwise the husband's assets would have gone to the wife. Then when the wife dies with a $1.2 million estate, $235,000 in death tax. But if they had done the AB trust, there'd be no death tax. And that was essentially the sales pitch, rightfully so, to save $235,000 in death taxes. Now, since 2011, right, since with the Obama changes in the estate laws, Now the wife can inherit the husband's $600,000 exemption, which is now 6 million, 12 million, right? So that husband or that wife can inherit now if you file a portability return. So it's very important. You can inherit that if you're a surviving spouse, but you must file a Form 706, which is a death tax return. That is what's called a portability return. If you have lost a spouse or you have lost, you have a loved one who lost a spouse, you really do need to talk to your A team, your CPA, your attorney, your financial advisor, and consider filing a portability return. I think it's a mistake, even on a small estate. It's a mistake not to investigate it. Okay, whether you file it or not, obviously it's different situation. It can be different, but at least investigate it. Do you think Biden might get rid of 706 portability amount that was already filed? No, that's locked in. So you get that as long as you don't remarry. Do you have a list of CPAs you refer to? I'm looking for a new CPA. Yes, you can just reach out to us and we'll get that to you. Nancy asked if a trust is created in a state that has no death tax, Virginia, for example, but the sole asset is a home in California, which rule applies? California has no death taxes, but the federal death tax applies to all states, right? To all citizens, all residents. So that's a federal death tax. Other states have an inheritance tax. Well, let's look at Hal and Wanda and their mega Roth conversion. Hal and Wanda are in their mid 60s. And if you've seen some of our prior webinars, you might recognize Hal and Wanda here. Hal and Wanda are in their 60s and have recently retired. They have $1 million in 401ks and $1 million in other assets. They want to travel before their grown children, have children of their own, and they're eager to do a Roth conversion. So they've studied it, they've looked at it. They say, you know what, we have pensions and Social Security. We don't need the $35,000 a year minimum distribution, or maybe 70 by that time, right, if the account grows. So in the second year of retirement in the early 60s, Hal and Wanda have no income. So this is a great time to do a Roth conversion. You know, if you're not working and you're not hit your minimum distribution age yet, and you're in your 60s or 50s or 40s, it's a good time to look at a Roth conversion. So they're living off the $1 million savings outside of the 401k, and they work with their A team. Remember the A team from the 80s, right? Mr. T, George Papard. They work with your A team, and they roll Hal's 401k over to an IRA and then do a backdoor Roth conversion. So what that means is the Roth, you take that $1 million out, and you're taxed on that $1 million unless you do some other planning, but you pay a one-time tax on that money. And this is purely, I will tell you, this is purely a mathematical analysis. This is you taking emotion out of it. It's purely a function of math. And for this couple, it worked. Okay. So Hal and Wanda can now take tax-free distributions from their Roth or not. Okay. But they don't pay income tax on the Roth distributions. They also, in California, this is very important. So for those of you who are thinking about moving to California for retirement or leaving California, California does not tax Social Security benefits. Other states do. So it really does depend on, I would say the people that stay in California when they retire are, first of all, they're either very wealthy or poor. Okay. It's very hard if you're middle class to retire in California, but a lot of people move out of California for a few years, do their Roth conversion, then move back. Okay. And if you do that, many times you're not paying California income tax on your Roth conversion. And then you come back to California and, if you're making less than $80,000 a year, you're really not paying much in California income tax. I would say that the mega Roth conversion is on the chopping block. Some want to take away the backdoor Roth conversion and others want to limit it. But we don't know what the future is going to hold for Roth conversions. And if this is something that's important to you, I definitely would pay attention to it. I want to mention charitable trusts as fun. We've done charitable trust webinar in the past as fundamentally a tax deferral and arbitrage strategy. So one of the things we talk about a lot in our firm is tax arbitrage. What does arbitrage mean? Well, it means if you have a big lump of income coming in 1 year, but you're not going to have much income in the next 5 years, for example, or 10, sometimes it makes sense to spread that tax bill out, right? Because our income, we have a graduated tax system, and the more money you make, the more you pay as a percentage of your income. And so to arbitrage or take the difference between a higher and a lower bracket, many times you end up with more money. So Hal and Wanda want to sell appreciated shares of Apple. I use Apple as an example because everyone knows the company, okay? Hal and Wanda set up a charitable remainder unit trust. And what Hal and Wanda do is they put this, they set up this trust and they put the Apple stock into the trust, and then they sell the Apple stock. Okay. They take payments over a 10-year period. So over this 10-year period, they get more than $1 million, right? They'll get $1,137,000 over a 10-year period. And then at the end of that 10-year period, the charity gets $212,000. I'm assuming a rate of return in there. And the year that they set this structure up, Hal and Wanda get a $100,000 income tax deduction. Now, this is really important because that can be used to offset a Roth conversion. Okay. So you see how these pieces are starting to fit together, and really every case is different. You know, when I was in law school, my real estate professor, I went to law school in LA. He talked about the uniqueness of every parcel of real property. And then he thought, well, what about those condos over, you know, in Century City? They all look the same. But in this case, everyone is different. Every strategy is different. And here's one of the things that we give our clients. We have some assumptions on rate of return, but you can see the distributions in the first year, 200,000, then 177 and 152. And what you're doing is you're able to pay tax at lower rates than they otherwise would have paid if they had just sold the Apple stock outright. So are these sounding familiar? Perhaps you shouldn't have an AB trust or a B trust, but you might. I don't know. But for many of our clients, you know, they shouldn't have that. Outright distribution. So what that says is Johnny gets everything. Or stage distributions. The trustee shall distribute half at age 25, half at age 30. A more modern approach is to include what we call a trust protector. So a trust protector is someone who has power over the trust, but is not the trustee. We've got a whole webinar on that on our YouTube page. And basically, the trust protector can change the terms of the trust as long as everyone agrees. The trust protector can change the terms of the trust and save a trip to the probate court. The example I give with clients is if the trust says drive from Los Angeles to San Francisco on Highway 99, if you're from California, you're like, why would you go up 99? Why wouldn't you just go up 5? Well, if the trust was written before Highway 5 was built, for example, a long time ago, the trustee has to go up Highway 99 unless they go to court. And the court says, no, you can go up Highway 5. Well, the trust protector can say, you just drive up Highway 5. It'll save time. It'll save money. And that's the utility of a trust protector. Asset protection for the inheritance you'll leave to loved ones. I would say the number one threat to an inheritance is divorce. And I want you to think about your kids. I want to think about your kids' marriages or your loved ones and your loved ones' spouses. How are those marriages doing? Do you know? Are they rocky? Have they already been divorced? Having a wrapper around these inheritances that protects them makes sense for most of our clients, I will tell you. Advanced planning techniques beyond the living trust. There's a whole bunch of those. If you are at 5 million in assets and single, or 10 million in married, you really need to be paying attention to these advanced planning concepts, because I think a lot of people aren't. And a lot of those, your loved ones will end up paying a lot higher taxes. So perhaps you should consider my book. It is coming out, my second edition, very excited. Coming out February 22, 2022. For those of you who love, you know, math and numbers, it's 02222022. A lot of twos in there, but that's when my book is coming out. So the second edition. Family office services at Cunningham Legal, we offer what we call family office services that focus on tax planning and overall multi-generational wealth creation, protection and preservation. It is a year-long engagement. And we don't have a lot of families in this. We keep it intentionally small. It occupies a lot of my personal time with clients, which is fine. But it's really, we have a big meeting at the half of the year. It's like halftime in a game. If you could only talk to your team, if you're a coach and you could only talk to your team once during a game, it absolutely would be at halftime. You know, at the end of the game, at the end of the game, you can't really change the outcome. And so that's why we like to meet with these families, typically in the third quarter, and plan out, okay, you know what you're going to have in income, maybe planning going forward, we can mitigate some of those tax bills. And, you know, frankly, you know, a lot of our families have fairly complex wealth structure, right? And someone's got to pay attention to taxes. I will tell you, I don't think the advisors pay enough attention. That's why you need your A team, right? All these guys here, they need everyone's cell phone. I know this is done before cell phones, but I need if I'm working with you as a client and you have a CPA and you have a financial advisor, we need our cell phones, okay? Because we can't go through the red tape of the assistants or whatever it is. But if I'm thinking about your matter on a Friday at 6 p.m., I'm going to be texting your CPA or your financial advisor to say, hey, what do you think about this? I'm respectful of the time, but you see the point is I think the level of cooperation needs to be higher than it used to be, frankly, because I think it's getting harder as time goes by. It's getting harder to wade through these. Taxes are going up. But I would say too often people who need an A team, they don't have one. High net worth families, financial tax and estate planning affairs aren't fully coordinated. And coordination is so important. We had a meeting just last year, a couple months ago, and we helped save a client $300,000 in income taxes because the whole group was talking. I could never have figured that out on my own. The other advisors never would have seen the issue, but working together, we were able to save the client $300,000 in income tax. It was a lot of money. I would, again, they rarely communicate sufficiently with one another. And I think too often people overpay on taxes. I mean, I can't tell you how many times clients come in and I look and I say, for the last 5 years, we could have saved you, $200,000 a year. You'd have $1 million more just by turning a few screws, doing things a little bit differently. And I say this is like leaving the low-hanging fruit unpicked. And if you'd like to truly create a multi-generational wealth, consider a family office, and it starts at about 10 million in wealth for most families. Otherwise, there's not much value we can provide. But I want to thank you for joining us today. I want to thank you for watching us on YouTube. Subscribe to our YouTube channel. Please share this with people who you think can benefit from it. And if you enjoy our webinars, please review us on Google. You can just go to Google us and submit a review, but we'd really, really appreciate that. And if you'd like to arrange a time to meet with myself or someone else in our organization, or if any of this is of interest to you, you'd like to continue that conversation, you can certainly click request an appointment and it'll lead you through how to get to us. Also, you can call us at 866-988-3956. So with that, I will open it up for questions. So if you have any questions, go ahead and ask. So John asks, remember that Medicare looks back 2 years to determine your Part B monthly premium. The tax brackets for Medicare and income tax are different. Medicare has lower brackets. If you convert too much to maximize a Roth conversion, you might get a large increase in Part B monthly premiums 2 years later. John, you are absolutely right, 100% right. Listen, this is something you need an A team on this, right? You need to know. Here's the thing. I like some surprises. A surprise birthday party, I like. A surprise tax bill, I don't like. I personally, intellectually accept living in California and paying higher taxes. I've gotten over that, okay? I know a lot of my clients, they leave because they just can't mentally get over it. And that's a perfectly valid way of looking at it. But I do not like surprises. I do not like to be surprised thinking my tax bill is going to be one thing and then it pops up and it's something else. So I don't think anyone here likes those kind of surprises. And then we have Anonymous. What about a couple with 6 million? Is it worth seeing an attorney like you? Anonymous, that's a really good question. I think it's a function of age. And I would say if you're in your 40s, absolutely. If you're in your 80s, yes. Okay. Are you going to be doing advanced planning in your 80s? Probably not. Are you going to be doing advanced planning in your 40s? Probably, because you're still, your wealth is still increasing. So I would say yes, regardless. Well, with that, if you guys have any last questions, all right. Thank you, Preston. With that, I wish you all a wonderful day, and we look forward to seeing you again.